good afternoon, everyone. Thank you so much for joining in. Welcome to this talk show of India Factoring, one stop solution for your global aspiration. Thank you once again for joining in, and do let us know in the chat box where are you joining from. Let's talk about the chat show today and what is the purpose of it. The purpose of this chat show is to help SMEs and mid corporates understand what are availabilities in terms of factoring and how it can meet their financing needs. India Factoring offers working capital solutions through the factoring product aimed at converting your receivables into cash. The company is a subsidiary of a European bank called FimBank PLC and is registered with the RBI as an NBFC factor and also holds an authorized dealer category 3 license from RBI. Also, we are number one factor for last 3 consecutive years basis turnover as per FCI published data. Through our global network, we offer one-stop solutions around receivable financing. So this is about India Factoring and how India Factoring helps SMEs and mid corporates. Today, we have a very senior banker with us. He is a very senior banker and factoring professional, and he is joining us today to share thoughts about factoring, how it helps people. And this senior professional is having 20 plus years of rich and insightful experience in banking with expertise in corporate and retail banking, business development, product development, and credit. He's a specialist in factoring and supply chain finance. He's a well known name in the field of factoring and currently leads India Factoring and Finance Solutions Private Limited as its Chief Executive Officer. India Factoring is a market leader in export finance factoring and has consistently retained the highest market share since 2018. Besides acing his ever challenging role at India Factoring, he also loves to support students and young professionals by guiding them with his knowledge and wisdom. Please welcome Ravi Valecha. Hi Ravi, very good afternoon. Thank you so much for joining in. I'm sure this discussion is going to help SMEs and mid corporates understand how they can meet their financing needs.
Good afternoon. Pleasure to be on the very first live streaming of India Factoring Show. I'm sure it will be worthwhile talking and discussing matters on factoring and everything around factoring. Thank you so much for having me online.
Great. Thank you. So, for our viewers, Ravi is with us now and we will be starting our chat show. You can put in your questions, your thoughts in the comments. And Ravi will be responding to any questions that you raise. You can raise at any point of time. Let's start. So, Ravi, it's been 6 years for me that I entered this factoring world. And at that point of time, when I heard it for the first time, it was like factoring, what is it? And even today, many a times, I hear from people, do you work at factoring? Do you work at factory? So, what is it? What is it all about, this factoring world?
Yeah, you can blame to the unawareness to the participants in India. You can blame it to the regulators. You can take whatever it be. But factoring in India, globally, it is there for more than you can say half a century or so, possibly more than 50 to 60 years, possibly in Europe, US. It has been there since 1960s or so, or even earlier, possibly in little unorganized manner. But in India, it has been there since the, you can say, early 90s with the formation of initial factoring companies, subsidiaries of PSUs were there. However, the real genesis of factoring in India only happened when the law for factoring was promulgated somewhere in 2011 with Factoring Regulation Act. Why it is not so aware is because of the easy availability or predominance of the banking finance, the traditional banking finance, what we know all in India, that is cash credits and overdraft and pre-shipment and post-shipment finance. So that's why possibly it is not really reached its full potential. However, there are initiatives by the regulator now, so hopefully more and more people, and the initiatives taken by India Factoring also has made it more prevalent now across the country, and more customers, be it in the MSME space, SMEs, or even large corporates, understand factoring, and more so understand India Factoring. So hopefully the future is bright, and with the promulgation, in fact, yesterday itself, the regulation was amended. The Factoring Regulation Amendment Act was passed by the Lok Sabha, and it awaits the final approval from Rajya Sabha thereafter RBI guidelines. And hopefully we'll see some more traction on factoring world, and I see possibly next decade or so will be more important from factoring and supply chain, overall supply chain finance.
Thank you so much, Ravi, for sharing this. And for our viewers, please note that it is there since 1960s. It's not a new product. It's just that the awareness is not as much. And like Ravi said, there are a lot of efforts being done on this. Even Government of India is doing a lot because it's a product which is very useful. And at the same time, even India Factoring is trying to spread awareness also through this chat show. So soon, more and more people, Ravi, I understand that they will know factoring, and I would not be asked, do you work for factory? Because factoring would be known by then. So you mentioned
Absolutely.
that the product is already there, but most of the people don't understand it. So if you have to explain it in the layman's term, how the product works.
So you can say it's a very similar to the bill discounting which is offered by the banks traditionally. Bill discounting or export financing, how it works in India, is in a way of a bill discounting. So the customer gives each and every export shipment document, that is a bill, to the bank, and bank sends the bill on collection and finances against it, on financing part of it, from a post shipment part of it, and obviously there is a pre shipment angle also. So from that perspective, it's not really different. Only difference is that the factoring works on the basis of a pool concept, unlike a individual bill by bill basis. Globally, factoring works on the basis of a pool concept, where the multiple invoices generates a pool of availability. It's very similar to, you can say, working capital finance, like a CC, cash credit, where the underlying receivables and stocks, with a calculation you come up with a drawing power. In factoring world, that's called the availability which is generated, and on that basis you finance. So it is very similar, but unique proposition in a modern way, and at the same time different, because it's not just about financing part of it. It goes to additional facilities also. It's a bouquet of services which gets together, which is called factoring, which is financing, booking of the sales ledger, and the sales ledger for the complete for the customer. So we are ending up providing the sales ledger services also. Collections is another important area which the India Factoring gets into, the collections from the end buyer. In case of an export, it becomes even more important, where you end up providing not just collections, but even there is an element of a credit protection for the buyer. So in case the buyer goes bankrupt, we are able to, or defaults the payment, then we are able to cover that risk for the customer in India. Imagine, just to put yourself a little bit more explanation, the banks just finance and wait for the payment realization from the buyer to come in. However, in case of a factoring, we end up acting as a collection agent or service provider, directly through us or through our correspondent. Just to put things in perspective, an Indian supplier supplying goods maybe halfway down the world, say for example in Mexico, the language is Spanish, Portuguese, or any of the languages in Latin America. There is a challenge of time. We are working and they are sleeping, and they are working and we are sleeping. So we end up providing that sort of a service through our correspondent factor, based out of Mexico. So that provides us the insights from the local markets, the local practices. They may speak, it mitigates against the language risk or any other issues which is there. So, and on a holistic basis, factoring is not just a financing. It goes beyond financing. The most important part of factoring, I would say, is the deleveraging mechanism which factoring provides. So, factoring is essentially a true sale of receivable through the legal word called an assignment, by which the seller is assigning the invoices or selling of the invoices or the book debts from its books to the factor, and we become the owners of the books or book debts, by which it's deleveraging. It's the book debts gets converted into cash for the supplier, and essentially it just vanishes and gets converted into cash. So obviously it's a improving the ratios, improving the balance sheet on an holistic basis. So realistically speaking, it's not just a financing, which is a what banking service is. Factoring ends up providing much more than banking services.
Thank you, Ravi, for explaining it so well and in very simple terms. It's not only a financing solution, but it also offers lot many other facilities, like you rightly said, different law of land, different languages, timing. So all that hassle you can come out of if you are looking for factoring, and there are many more other USPs that you mentioned. So, who this product is for, Ravi? Now that you explained the product, what all, who all can utilize, or who all can look forward to having this facility?
No, so it's not that who all. I would say that it's open for everybody, in the sense that obviously it is not for the individuals. It is not a retail product. It's not for anybody doing a business on their own. I would say it's for MSMEs, right from MSMEs going up to the large corporates. Factoring is for everybody. Like a bank banking services or financing is for everybody. Likewise, even factoring was for everybody. uh, the differentiation is whether you are doing it for domestic, you are able to do the domestic factoring, and when you are using, you are into exports, you end up doing export factoring also. So I would not say it will be limited to anybody. As an institution, if you are an institution, you will be able to use the factoring product, be it MSMEs or even large corporates. It's open to everybody.
Thanks, Ravi, for clarifying this that it's not only for a particular segment, but it's open for all. Wonderful. So this brings me to another aspect that I mentioned in the beginning, that India factoring has been consistently rated number one when it comes to export factoring as per turnover criteria. What do you think? Like last 2 years, if we see, the overall export for India was around $290 billion, which was in 2020. This was COVID year, and despite that, the number was this. And if we look at 2019, a normal year, it was $330 billion. How do you see export growing, and how an exporter can get benefited by this product?
Yeah, so the numbers you have quoted is only the merchandise exports,
Yes.
the goods which have been exported. If you add possibly another 200 billion worth of services, so that takes the total to around about $500 billion plus of exports from India. And obviously, with the initiatives of the government, there is obviously the initiatives of Make in India, Atmanirbhar, and whatnot, to make India as one of the exports destinations, make the suppliers base for the world across, from across the sectors, across industries, from apparel to products, be it automobile components to electricals and whatnot. So there is a huge potential, and if you really cull out that information from a 500 plus $1 billion, take out the capital goods which may not be factorable, take out possibly some other elements, and the elements which are LC backed, that is a documentary credit backed, and leave out only the open account transactions, which are short term in nature, possibly 180 days or so. Uh, I believe that number comes to around about today's scenario, it comes to around about $70 billion. As against that, India's factoring volume, in a sense, is roughly around about $5 billion or so. So that's a gap of 65 billion. Obviously, I'm not saying that the gap is not getting fulfilled today. The gap is getting fulfilled by the traditional means of banking finance. However, as I have explained, that there are benefits against the banking finance vis-a-vis the factoring. There is a huge potential for the factoring services to reach out to, that is already a $65 billion opportunity, which can be scaled up. And as we speak, possibly the LC's business, that is traditional documentary credit business, is the dying business, because more and more the world is getting entrenched, and there is increasingly non-requirement of an LC, uh, and move out to the more open account transactions. That's the demand from all the growing large corporates across the world. And what better than a factoring product to suit and fill that gap for the factoring, for the customers, for the export customers. So I see that $65 billion growing. The pie is huge already, but the pie is expected to be even growing further in possibly another few years, and even now.
Yeah, great. So there's a huge gap, and like you said, LC is dying. So this is one product which can be looked at. And here I would like to ask you this, which one of our audience has asked: what is difference between credit insurance and factoring?
Yeah, so a difference is, it's not really a difference. I would say credit insurance is one of the aspect of factoring. As I said, it's factoring is not just a financing mechanism; it is a bundle of all services put together, which is financing plus other services which I just mentioned: collection, sales, ledger management, and even credit insurance. So credit insurance is one of the features of factoring in a sense, where the factor ends up providing a coverage, that is the buyer risk coverage, that in instance where the buyer is defaulting on a payment, the factor is fulfilling that promise that they will honor those commitments. Obviously, there are subject to terms and conditions and subject to other requirements, but it fills that gap and provides a service element along with the financing part of it. So I would say that credit insurance is one of the features, important features of factoring service in a nutshell.
Thanks for this, Ravi, and we will be taking one more question here. The question is:
Sure.
how soon can we find out limits availability on US or European buyers?
Yeah, so it's not a question of how soon. It's a question of, I would say, the function of the how big or how small, or the credibility of the buyer. So once you have the request coming in, obviously, if it, for example, it's a GE, it's one of the largest buyers across the world, or possibly similar name, it's a AAA rated buyer, then the limits can be available on tap also. But obviously, if it is a mid corporate or a small entity, then the limit availability may be a little deferred. So I would not say I would say it's a function of the credibility of the buyer, the market where we are talking about. GE, for example, US, factoring is very, very prevalent. The limit availability will be easier. The data available is easier. The credit bureaus are there. It's a developed world in a sense. Likewise, in European continent, if you ask the buyer in Africa, possibly the availability of credit insurance will be less, delayed, and possibly may end up taking a lot of time. So it depends on the market. It depends on which is the buyer, the credibility of the buyer. But in a sense, it's completely dependent on what functionality, which country, which category of the buyer which you are looking at. So I would say, anywhere from a day to possibly even 15 days is possible in difficult situation where the details of the buyers are not readily available, where the correspondent factor or the insurance company has actually to start work ground up to understand who the buyer is. So it's completely dependent on who the buyer is, which country it is looking.
Thanks, Ravi, and this is amazing. I mean, 1 day to 15 days, a very decent time to get these approvals. And if you get, like you said, there is a possibility that you get it in a day's time, then what more do you want when it comes to your financing needs? So questions are pouring in, and I would take few more from our audience. So another question is: what is longest tenure for factoring?
Factoring is basically a short-term financing requirement. So anything, a working capital. It's not a capex product. Usually, in a usual circumstances, it is 180 days. But anything less than 1 year is something which can be factorable. Obviously, 180 days is the easiest. If you go beyond 180 days, then It is subject to what is the industry, what is the seller buyer combination. Also, it is dependencies there on the RBI regulations also being there. That how what is the longest period? I believe the last notification from RBI allows up to 270 or 240 days or so, but that regulation keeps on changing depending on various situations. Like for example, current pandemic situation, possibly it could be a little higher, but it keeps on varying. But in a sweetest spot, I would say up to 180 days is something which is the best possible thing.
Thanks, Ravi, and I'm sure our audience are getting a lot of value from here. And to all the viewers, please keep pouring in your questions. We have an expert, Ravi Valecha, here who is responding to all your queries related to factoring. So keep them coming. And Ravi, this brings me to another discussion that why should a business look for factoring as working capital finance? There are so many options, and you mentioned some of them already. So, if they have to look for factoring, what should be the USP or one thing that you would say factoring would help them with?
Yeah, so factoring should be, what a customer should end up looking at is possibly a one-stop solution. A customer in India, possibly it's not completely, depends on where he's supplying. So for a customer, say for example, a mid corporate supplying goods to both Indian buyers as well as exports, they should ideally look for one-stop solution. I would recommend that they work with an established entity which is regulated by the guidelines of the regulator, which is RBI, uh, like in India factoring, or there are other factors who are there. Why it is important to be working with a regulated entity is you don't work with an unregulated bank, right? You end up working with regulated banks. We are required to maintain that sort of a governance from a local guidelines point of view. RBI is there as a regulator to govern the banks and non-banks both, and that's why it is important to work within the framework of the requirements. The important aspect is that the regulator did not just gives license for operating as a factor. It also requires when you're routing documents, you need to route all the documents from an export point of view, if it is exports, through an authorized dealer. And that is an important element because you do not want to run with multiple partners. That is, one is who's financing, the other one who's doing your exports bills collections. So you end up having a two touch points. One is financing point of view, you deal with somebody, and then you end up routing the documents to another bank, or getting collections in another bank who will help you close the exports bill finance from an regulation point of view. uh, I would suggest that it should be a one-stop solution where a factor like an India factoring can provide one-stop solution. We end up providing, besides all the other features I just mentioned, these are two important elements where you end up working with one factor who will fulfill your all the requirements from an export finance point of view. And obviously the benefits of working with the factor I've just explained. Besides that, these are the important elements which the exporter or the seller in India needs to consider as well. Uh, that's it.
Yes. So thanks for explaining this, and I'm sure our audience is getting more and more understanding about when and how this product can be used. And you said that it can be a one-stop solution. What better than that? You have all your needs met through this. Another question which our audience is asking is how this product is different from bank finance, and is it visible on the balance sheet? Is this debt visible on the balance sheet?
Yeah, so as I mentioned, it is a true sale of receivables. So you are assigning the receivables to your factor, and which means the agreement, the underlying agreement is not a loan agreement; it's an assignment agreement, because of which it is considered as a deleveraging exercise. You can sell off the receivables. There are two elements again. There is a component called with recourse and something called without recourse. Even in with recourse, where we say that in case the buyer doesn't pay after a particular grace period, then the recourse is established on the seller. However, even then, the basic agreement remains as an assignment agreement. We always have an option for exercising that recourse capability on the seller after a particular period or so. I believe that till that point of time, it can be considered as a assignment, can be true and established thing, and it will be considered as an off-balance sheet with a requirement of a contingent being created on your balance sheet. That's on a with recourse. However, on a without recourse basis or a partial recourse basis, if the contingent doesn't come in, because the contingent will not be there because you are providing a buyer risk coverage also and a without recourse capability. In such a situation, it's a complete off balance sheet where the exporter does not, where the seller does not require to create even the contingent liability, and that's why it is even more beneficial from a seller point of view, that it helps you hive off the book debts, convert them into cash, and make your balance sheet light and effective.
Thank you, Ravi. And here's another question. Anoj Sidhu wants to know, is factoring comparatively better than LC transactions in terms of pricing and other aspects?
Yeah, absolutely. Uh, before that question, I'll just go to the background. Why is there an LC requirement? Put yourself possibly 50 years back, and maybe even more. The transactions which used to happen, say for example, because we are in India, I'll just take an Indian seller only and selling to, say for example, in Mexico or US. Both the buyers and the sellers, they don't know each other. Okay, they don't know each other, and that's where there is an element of mistrust, or what if the payment goes bad. So that's where LC was brought in picture, letter of credit, which essentially means that, okay, maybe a bank in India knows a bank in US in a more established mechanism. They can be trusted. They can trust on the bank rather than an independent buyer in US or Mexico. So a bank underwriting a risk was much easier and fulfilling and secure mechanism for a seller in India, and that's why the emergence of LC was there. However, this LC was very cost sensitive and high on cost, because each transaction you require an LC. Of course, it can be a revolving LC, but even then, it's a transaction by transaction. So, besides the cost element, it is quite an operational heavy on the seller and the buyer also, because each transaction will have to have an LC. So a cost element, a service element, and an operational element also comes into play, that each and every transactions needs to have a separate LC, or even if it is running LC, there needs to be appropriate documentation under the required document under the LCs. Plus, the terms and conditions which are agreed upon in the LCs can be quite baffling. And in any situation, if the terms and conditions or the clauses which have been mentioned are bypassed or not fulfilled to their potential, then there is an element of risk. However, compared to that, an export factoring or manufacturing element is works on the basis of an open account, where you do not require any bank to underwrite that sort of an LC or provide sort of an LC. Of course, bank underwrites in export factoring also, wherein the bank is providing a credit coverage. So it's like a limit which is being provided for, say, for example, 6 months to 1 year. Under that, you can continue providing doing as many transactions as possible. Increasingly, the buyers across the world are moving from an LC-backed structures to open account. And why is that? Because the world is getting, has already rather, got more and more entrenched. Today, uh, you require any information, it is available at the click of the button. Google it, you get any information, you know the buyer, you know who they are, located across the world. So the information availability is much easier, and that's where uh, 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 you're not into a completely unknown area. Of course, you still need to cover your risk, and that's where it becomes increasingly dependent, that how you can move from an LC structured, where the information was completely unavailable, to the current situation where it is in, the information is available. Of course, you still need to cover your risk, and that's why you are okay to transact on an open account basis. It has been observed over decades now that the world of LC, of course, it's going slow, but it's declining, and the prevalence of open account is gradually growing. With the ever entrenching supply chain finance or supply chain now, the growth of supply chain finance has also been seen, which is also operating underlying, using the underlying factoring as the underlying arrangement. So definitely there is a increasing reliance on being an open account, and this is what is being asked by the global buyers across. So difference is there. There is a huge difference. One is the cost element and the time element and the operational element from an LC to a non-LC. It becomes much more conducive and an easy way of doing business in today's environment. I hope that explains.
Thanks, Ravi. I'm sure this was very clear to Anuj, and he got the answer that why LC and how the world is moving towards open account, and that's where the factoring comes into picture and all the other features that you shared. Thank you so much. So this brings us to the end of the chat show, and here's my last question to you. As a senior industry professional and CEO of a non-bank, you are connecting with exporters, businesses all the time. So, what is your one advice to our businesses in these difficult times? There's so much uncertainty. We don't know when this will end, when third wave will hit, and what's going to happen.
No, so it's important that in times like this, in fact, times like this, that is a black swan event sort of which is there in pandemic. These sort of products get tested, and what better than today when we know that the in today's situation it's so dynamic that we know that the buyer who was very strong possibly may not be so strong in future. So that's why it is an increasingly important requirement to go for securing your risk on the buyer. Even if it is for the strongest of the strong buyer, we have seen situation changing, and obviously you would want to go for a credit insurance. You would want to, in today's times, there is also a strain on liquidity. Banks possibly maybe sitting tight on financing. There might be strain on the liquidity because your receivables are getting elongated, or and whatever be it, the costs are continuing. You're working from home, your costs are there, your fixed costs are also there, the salaries are to be paid, etc., etc. Everything is there. So there is a strain on liquidity, there is a strain on risk coverage, and there is a strain on working capital also, and that's where it is important to have a solution which can provide you gaps, provide you solution from all these aspects. That's where the factoring comes in. It's not just financing; it secures your payment, it deleverages your balance sheet, makes your balance sheet effective and clean and more suitable for all from all perspective. And that's where I see that the situation evolving for the factoring world to grow even further. The current environment is changing dynamic. Obviously, it is going to be there. We saw first wave, second wave, and possibility of third wave lingers also. However, the business has to go on. The second wave has been much severe from an health point of view, but from an industry point of view, I think it was much calibrated. There wasn't any complete shutdowns also, which affected the industry. There was continued industry momentum also. Hopefully, the third wave should be also controlled, and that's where I see that possible. All the indicators, economic indicators, are positive, and I see that the exports are growing, and likewise, even the domestic transactions, domestic economic scenario is developing much positive, and I'm very, very optimistic of the year to follow through. Thank you so much.
Thank you so much, Ravi, for sharing this, and your positive words, positive outlook look will give confidence to many more, because it's all about being gloomy these days. So that if there is a ray of hope, it's absolutely amazing. And thank you for bringing in this aspect that you need to look out, you need to bring in different solutions. Whatever traditionally has worked would not work now onwards, and that's where there have to be other solutions. Thank you, Ravi. Thank you so much for responding to all our questions and enlightening our audience with information about factoring. Thank you. All our audience, I'm sure you found value in this show and you understood about factoring more and more. We will keep coming back with different experts. Until then, I'm taking your leave. Thank you so much for joining in.